You hear words like index funds, mutual funds, ETFs, and hedge funds everywhere, but nobody explains them simply, causing confusion and fear around investing for beginners. This video explains funds in plain English, without complicated terms, so you can finally understand how they work and choose wisely. This is educational content only, not financial advice, meant to help you learn basics confidently before making any personal financial decisions. Imagine planning a party with friends where everyone contributes money instead of one person paying everything alone. That shared money allows better food, drinks, and decorations, while reducing stress and cost for each individual involved. A fund works the same way by pooling money from many people into one large investment pot. That pooled money is invested into assets like stocks, bonds, or real estate by professional managers. Investors then share profits or losses based on how much money they contributed to the fund. Funds help regular people invest without needing huge money or deep market knowledge. Now let's understand the main types of funds you often hear about. Index funds are one of the most popular investment choices discussed online and recommended by many experts. An index fund does not try to beat the market or pick winning stocks. Instead, it simply copies a list of companies called an index. An index is like a scorecard representing part of the market. The S&P 500 tracks 500 large American companies across different industries. Nasdaq mainly tracks technology-focused companies like Apple, Microsoft, and other major tech firms. There are also indexes for small companies, international markets, and specific industries. Index funds follow these indexes automatically without human stock-picking decisions. This is called passive management, which keeps costs very low. Lower fees mean more of your money stays invested and grows over time. Index funds spread money across many companies, reducing risk from one company failing. They are priced once per day after markets close, not traded instantly. Because of simplicity, low cost, and long-term results, index funds are highly recommended. Mutual funds look similar to index funds but operate very differently behind the scenes. Most mutual funds are actively managed by professional fund managers. These managers try to beat the market by choosing stocks they believe will perform better. Active management means higher effort, research, and decision-making involved. Because of that, mutual funds charge higher annual fees. Higher fees reduce overall returns, especially over long periods. Studies show most active managers fail to beat the market consistently. Some people still choose mutual funds for specific strategies or niche investments. Like index funds, mutual funds are also priced once daily after markets close. Next, we move into a completely different world called hedge funds. Hedge funds are private investment funds for very wealthy individuals or institutions. They use aggressive strategies like borrowing money or betting against stocks. These strategies aim for very high returns but involve serious risk. Hedge funds can make huge profits or massive losses quickly. They charge extremely high fees compared to other funds. The famous fee structure is 2% yearly plus 20% of profits. Because of risk, only accredited investors are legally allowed to invest. Hedge funds are not suitable for average people or beginners. Now let's talk about ETFs, one of the most flexible investment options. ETF stands for Exchange Traded Fund. ETFs hold a basket of investments like stocks or bonds, similar to index funds. But ETFs trade on stock exchanges just like individual stocks. You can buy or sell ETFs anytime during market hours. This gives real-time control and flexibility to investors. Most ETFs are passively managed and track indexes. Because of this, ETFs usually have low fees. They are easy to buy through investment apps and brokers. ETFs combine diversification with trading convenience. Now let's simplify everything and help you choose. For most long-term investors, index funds or ETFs work best. They are simple, low-cost, diversified, and historically reliable. ETFs are better if you want flexibility during the trading day. Mutual funds may suit people who trust a specific manager's strategy. But remember, higher fees and inconsistent performance are risks. Hedge funds are only for wealthy investors who accept extreme risk. They are not meant for everyday people building long-term wealth. Understanding funds helps remove fear and confusion from investing. You don't need to be rich or smart to start investing. You just need clarity, patience, and the right tools. Index funds and ETFs are powerful tools for most people. They allow slow, steady wealth building without stress. Learning these basics puts you ahead of most people financially. The goal is not quick riches, but long-term financial stability. Knowledge protects you from bad decisions and scams. Always learn before investing your hard-earned money. Start small, stay consistent, and think long-term. If this explanation helped you, support the channel with a like. Subscribe for more simple finance explanations without confusion. Watch the next video to continue building your financial confidence. Thanks for watching. Subscribe.